Usually when a company more than doubles its revenue in a single year, you sort of just expect the stock chart to look like a rocket ship.
Right. I mean, that's the classic growth story. You sell way more product, the market rewards you, and the price just goes straight up. It's supposed to be simple.
Exactly. But then you look at the recent price action for Celsius, and it's like someone took that script and just threw it out a window.
Oh, completely.
I mean, we are looking at a company seeing astronomical top-line growth, but at the exact same time, the stock is just collapsing. It's down nearly 38% year-to-date. It's
Yeah.
trading right around $27.17 right now.
It really has become the absolute definition of a market battleground.
It has. And welcome to Market Pulse Daily, everyone. Today, we are unpacking this massive financial paradox.
There is just so much to get into with this one.
There really is.
Yeah?
And hey, real quick, before we look at the underlying numbers, if you are trying to map out some of these wild chart movements at home, you might want to check out VIP Algos. It is a visual indicator suite designed for TradingView, and we do have an affiliate link for it down in the description.
Right, and we always need to be clear about this. VIP Algos is strictly for educational chart analysis. It is definitely not financial advice.
Exactly. It doesn't guarantee any profits, and obviously trading always involves risk, so you have to do your own research and manage your downside.
Always.
But yeah, it's a neat tool. Anyway, let's get back to Celsius, because the numbers we are seeing in the research are just staggering. How does a company grow revenue by over 123%, but lose almost half its value in 6 months? It's like looking at a sports car with this massive engine, but there's a giant leak in the gas tank.
I actually love that visualization, but let's take it a step further to explain the mechanics. Think of it like building a house, right? The roaring engine is the framing going up in record time. But to build that fast, the company is basically paying overnight shipping on every single brick and, triple overtime to the crew. So the house gets built, the sales happen, but the profit margins are just getting destroyed by the logistical chaos of moving that fast.
Right, so you have to separate the money coming in from the money they actually get to keep.
Exactly. And let's look at the top line first, the actual house being built. The trailing 12 months revenue growth is sitting at an incredible 123.34%.
Which is insane. They more than double their sales.
Yeah, and they're holding on to a gross margin of 49.62%.
Wow, almost 50%. So people are clearly still paying a premium at the register. They aren't just slashing prices to move product.
Right, which tells us their pricing power is still really robust. I mean, gross margin just measures what's left after you pay for the physical product.
Yeah.
The water, the aluminum, the caffeine.
Yeah.
So keeping 50% there means the consumer demand is genuine. The brand is strong enough that they don't have to race to the bottom with competitors.
But, and here is that massive leak in the gas tank we talked about. Despite all those sales, the culprit behind the 38% stock drop is severe margin compression further down the income statement.
Yeah, this is where it gets ugly.
Because while the gross margin is great, the net margin has just plummeted down to 5.85%.
And net margin is the ultimate truth teller. That is what is left after you pay for absolutely everything. The marketing, corporate overhead, taxes, and most importantly, the supply chain logistics.
So dropping from nearly 50 to under 6%.
Yeah.
That is a huge internal efficiency problem.
It really is.
So what is actually causing that internal bleed right now?
Well, the data points to a mix of rising input costs across the board and the friction of integrating lower margin acquisitions. When a company buys another business to expand, they usually inherit these really inefficient distribution networks.
Oh, like parallel shipping routes and stuff?
Exactly. Until you consolidate all of that, you're double paying for warehouse space, you have overlapping supply chains. The cost of running this suddenly massive machine is just swallowing the cash generated by those record sales.
So management absolutely has to fix this. Because you can't bleed out on the bottom line forever, no matter how popular the beverage is.
Right, and management is actively chasing aggressive supply chain savings. They are hunting for operational synergies right now, but their forward-looking guidance suggests we are heading into a pretty tricky quarter for consumer staples broadly.
The market is basically holding its breath to see if they can leverage this new massive scale to negotiate better deals, or if costs will just keep spiraling.
Exactly. Financials only give you the current math. But to see if they can survive this tricky transition, we have to evaluate their armor.
Right, their competitive moat.
Yeah, because brand equity tells you about the durability of the company over the next decade.
And their primary moat is undeniably that brand equity. the research highlights that Celsius isn't viewed by its core demographic as just a cheap caffeine fix. It's really positioned as a fitness lifestyle product.
You see it at the gym constantly. It's integrated into wellness routines on social media.
Yeah, and that creates a fascinating psychological switching cost. Like, if you identify as a healthy, active person, switching to one of the older legacy energy drinks suddenly feels like a step backward in your personal lifestyle, not just a different beverage.
And that psychological loyalty translates directly to the bottom line historically. I mean, over the past 10 years, this company has produced an average annual return of 45.33%.
45% on average. That's incredible.
Right, but you need a fortress brand to sustain that.
But, no fortress is immune to a siege. And we have to talk about the external risks, because there was a major one pulling the stock down right now.
The regulatory side.
Yeah. International expansion is huge for their valuation. But the UK government has officially confirmed a ban on the sale of high-caffeine energy drinks to children under the age of 16. And this is slated to go into effect in April of 2027.
And the market reaction to that was just immediate. We saw multiple analyst price target cuts right away.
Because of the contagion fear. Right?
Exactly. If the UK implements this and normalizes the policy, other major markets might adopt the exact same framework.
So if you're an investor, you have to ask what this actually means. If a major market bans the product for a specific age group, does that permanently cap their total addressable market? Or is this just a headline scare?
Well, it alters the foundational math. A growth stock's valuation heavily depends on calculating future cash flows based on that total addressable market, the TAM. If a whole demographic is removed by law, analysts have to shrink their TAM models.
The ceiling comes down. But wait, consider who is actually drinking this. The bull case in the research points out that their core demographic isn't kids, is health-conscious adults, college students, gym goers.
That is the pivotal debate right there.
Right, like if the core adult market stays intact, isn't the actual revenue hit from an under-16 ban likely to be way less severe than the panic implies?
It really comes down to whether they secretly rely on teenagers for volume, or if that premium positioning naturally skews toward adults with disposable income.
Right. So with all these fundamental headwinds and regulatory fears out in the open, opinions are everywhere. But opinions don't move markets.
No, money does.
Exactly.
Yeah.
So we need to look at how the actual buyers, sellers, and insiders are behaving on the charts today.
And pivoting to the market sentiment data reveals a really complex structure.
So the stock is at $27.17, which is dangerously close to its 52-week low of $27.47. Usually, hovering near the lows feels like catching a falling knife. But the data shows this exact level is a historic price floor.
Yeah, it hasn't just randomly stalled out here. It landed on a deeply entrenched high-probability bounce zone. Looking back, this specific level has launched major rallies exactly 7 times before.
7 times. Wow.
It is a technical juncture where contrarian buyers historically step in, look at the discount, and start accumulating.
And this is exactly where everyday retail traders are using tools like VIP Algos to map this out in real time. They use those visual buy and sell alerts to see if this historic 7-time floor is going to hold for an 8th time or if it's finally going to cave.
Right, and while retail is looking at those support lines, the institutional flow seems to be quietly shifting.
Really?
Yeah, volume is in a normal regime right now. The 10-day average is about 7.94 million shares.
Yeah.
That kind of volume profile usually suggests a choppy bottoming process.
Okay, so the momentum chasers are washing out.
Exactly. The funds that only bought because the line was going up are selling, and value-oriented funds are stepping into established long-term positions at a steep discount.
Okay, I want to push back on that for a second, though, because if value funds are quietly buying, we need to talk about who is enthusiastically selling. The insider flow data in the research is, well, it usually triggers massive alarm bells.
You're talking about the executive selling patterns over the last quarter.
Yes. The insiders, the executives, the board members, they have been heavy net sellers. Over the last 90 days, the data shows net selling of over 5.38 million shares.
It's a big number.
It's a huge number. We were talking about just 3 insider buys compared to 39 insider sells. The insider sentiment score, the MSPR, which tracks the ratio of buying to selling on a scale of positive to negative 100, is sitting at a negative 100.
Yeah, the lowest it can go.
Right. If the people running the company are aggressively dumping millions of shares at the exact moment the stock hits a 52-week low, how is that not a massive red flag?
I mean, It is entirely intuitive to see a negative 100 score and assume the ship is sinking. But for high-growth companies that have had massive multi-year run-ups, corporate compensation is a bit more nuanced. Remember that 45% average annual return over the last decade?
Yeah.
Executives hold a vast majority of their net worth in company stock, and their compensation packages often include automated selling windows.
Okay, I understand the concept of diversification, but 39 sells to 3 buys at the absolute low. That's not just a few executives buying vacation homes. That looks like a systemic exit. You can't just wave that away as personal liquidity when the stock is already down nearly 40% this year.
Look, that is a completely fair critique. It absolutely warrants caution. It shows a lack of appetite among management to buy their own dip, for sure.
Yeah.
But consider the alternative perspective. If an executive held shares for 10 years through a meteoric rise, cashing out a portion of that wealth might happen regardless of the current local bottom. Historically, institutional accumulation is often a more reliable signal for future direction than insider selling at this very specific, mature stage of a company.
Okay, fair enough. So we have a stock sitting on a historic floor. Retail is watching the technicals, institutions might be accumulating, and insiders are taking profits. But a stock can just sit on a floor forever. What is the actual spark?
The catalysts.
Right. What is going to ignite the next big move?
Well, the immediate hurdle is the upcoming earnings report. Expectations are heavily muted right now. Wall Street is fully prepared for a rough quarter.
Which honestly might work in their favor. A low bar is a lot easier to clear.
That is the bull case right there. If Celsius can step up and demonstrate that they have stabilized those net margins, even just incrementally, while maintaining anything close to that 123% revenue growth, it forces a massive narrative shift.
Because the whole reason people are selling the out-of-control costs would be invalidated.
Exactly. Analysts would have to revise their targets upward.
And beyond earnings, the research mentions some speculative rumors swirling around management's push for supply chain savings.
Right. There could be a major strategic operational announcement coming.
If they announce a massive efficiency synergy from their recent acquisitions, like something that permanently lowers the cost to produce and ship a can, that could completely catch the market off guard.
And with sentiment this negative, a positive surprise could violently force short sellers to cover.
Oh, for sure. If traders betting against the stock are suddenly hit with good news, they have to buy shares to close their negative positions, which just spikes the price higher.
We also have to zoom out and look at the macro wins. There is a broader macroeconomic sector rotation happening right now into growth stocks trading at reasonable valuations.
And Celsius definitely fits that bill. Their price-to-book ratio is sitting at 2.42.
Which is very low for them.
Yeah, I mean, that metric basically compares the stock price to the literal accounting value of the company's assets if they were liquidated today. For a high-growth brand to be priced that close to its base asset value is really unusual.
Plus, they are highly rate sensitive. Growth stocks are valued based on future earnings. When interest rates are high, analysts discount those future earnings heavily. But if macro data cools down and interest rate pressures ease, a high-growth consumer name stands to benefit disproportionately.
And finally, we have to keep an eye out for any upcoming Investor Day announcements about their international strategy. The market really wants answers about the UK ban.
Definitely. If management presents a clear, aggressive strategy that bypasses the under 16 ban, that removes a massive cloud of uncertainty.
Okay, so synthesizing all of this data, the high revenue, the low margins, the brand moat, the historic technical floor, and all these macro catalysts, what is the final outlook?
So looking at all the pros and cons, the research assigns a bullish score of 7 out of 10.
Okay, so leaning positive.
Yeah, but we need to be clear. We are not giving buy, hold, or sell ratings here, and we aren't telling anyone what to do. The argument in the data is simply that the pressing near-term margin headwinds and the UK regulatory fears are largely priced into the valuation at this $27 level.
Basically, the bad news is already baked into the cake.
Exactly. And what you are left with is a company backed by a fortress brand, still delivering exceptional top-line growth. The conclusion from the data is that it offers a rare bargain, but there are obviously key risks. Management has to successfully execute that aggressive supply chain pivot.
Right. It really is a fascinating standoff. For you listening, it comes down to the tension between a beloved lifestyle brand and the unforgiving reality of corporate margins. Can they fix the logistical nightmare of scaling too fast before the market loses patience?
It's going to be the ultimate test of their operational discipline versus their marketing brilliance.
Well said. And as we wrap up today's episode, I want to leave you with a final thought to mull over. We talked a lot about the UK banning these drinks for kids under 16 and how that shrinks the market on a spreadsheet.
Right.
But think about the psychology of a lifestyle brand. If a product is so deeply ingrained in a fitness aesthetic, at what point does a government ban actually increase the product's rebellious mystique for younger consumers?
Oh, wow.
Like, does being told by the government that you aren't legally allowed to consume something suddenly make it the exact cultural status symbol you want the most?
That is a really fascinating psychological angle.
Right. It's something to think about. Well, that is all the time we have for today. Don't forget to subscribe so you never miss an episode of Market Pulse Daily.
And if you want to level up your educational chart analysis, be sure to check out that VIP Algos affiliate link in the description. Just remember, trading involves risk.
Always. Thanks for listening, and we will catch you next time.